gives us immense pleasure to bring to you the Power of Three concept for creating the core of your equity portfolio. UTI Mutual Fund has been one of the early adapters of the process of categorization and rationalization initiated by the regulator to bring about simplicity and uniformity in our product offerings. It has always been our endeavor to be true to label, and with this exercise provides us with an impetus to offer to you, the investor, clear and distinct products from our portfolio. UTI Mutual Fund's Power of Three concept emphasizes on the need to build the core of your portfolio with large and multi-cap funds, and also the need to have distinct investment styles in your portfolio. The three products that we have selected have a long track record in the industry and are trusted by millions of investors. UTI MasterShare Scheme, India's first large cap fund, follows the growth at reasonable price, or in short GARP style of investment, which in short can also be termed as a blend of growth and value styles of investment. Next, UTI Equity Fund. With a vintage of close to 26 years, it is a multi-cap fund which follows the growth style of investing. And finally, UTI Value Opportunities Fund, which, as the name suggests, follows the value style of investment across the market capitalization spectrum. With these three distinct offerings, an investor should be able to create a well-balanced core equity portfolio for creating wealth in the long run. With that short preamble, let's hear about the respective investment styles in detail.
Hi, I am Swati Kulkarni. I am part of the investment team at UTI Mutual Fund. I manage equity funds, and I want to talk to you about my investment style, which hinges around growth at reasonable price, and I prefer companies with competitive franchise. I believe competitive franchise is built over long period by companies that are fundamentally strong with well managed capital structures reflected in low leverage, consistent revenue growth, focus on profitability as measured in terms of stable EBITDA margins, higher return on capital than the cost of capital, and consistent operating cash flow generation. Such companies generate free cash flows for future expansion and avoid dilution of existing shareholders. Some of the other aspects that I consider are market dominance, product penetration levels, consolidation in the industry, brand and distribution strength, etc. These factors provide pricing power, which is very crucial to sustain the competitive advantage. For global cyclical sectors, however, which lack pricing power, I look for the cost efficiencies and the capital efficiencies. In addition to these fundamental aspects, softer aspects like management quality, governance standards are also considered. Growth at reasonable price approach is compatible with value to the extent that you are evaluating the underlying growth and how much you are willing to pay for that growth. The blend helps in identify companies where the market is underestimating either the company's ability to sustain growth over a much longer phase or the benefits of pricing power that the companies derive. The growth trajectory is improving on favorable demand cycle, consolidation in the industry, clearances of regulatory hurdles, so that could also be captured through this approach. Also, where the companies or the businesses are capital intensive, the companies which invest in prudently or they execute efficiently can be captured through this approach. Thus, it helps in selecting companies having future earnings growth as well as valuation comfort. Large cap companies, through their market dominant positions achieved through sustained competitive advantages, can be very good compounding return stories over long period, defying the myth that multi-baggers are discovered only when they are small. Just to give an example, large companies in financials, pharmaceuticals and automobile have multiplied more than 6 times in last decade. Further, companies with strong governance standards tend to outperform over long period. At different points of time, stocks and sectors tend to trade at extreme valuations as investors chase what is in fashion and ignore what is distressed valuation. I believe GARP approach and sound investment process backed by investment professionals allows me to identify and hold on to such investment ideas to make money. I tend to avoid investing in companies which are highly leveraged, have structurally low ROC, inefficient capital allocation and bloated cost structures. Also avoid companies where the fortunes are linked to an occurrence of certain event, and companies having corporate governance lapses are also no for me.
Hi, my name is Vetri. I am the head of equity at UTI Mutual Fund, and today I am going to be talking to you about my investment philosophy, which I would essentially define as an approach of value investing. Value in my book is buying things for less than their intrinsic value. Intrinsic value itself is simply the current value of the cash flows that the company generates for its shareholders over time. Of course, there could be situations where value could be unlocked by way of asset sales, but those by definition are special situations and don't come by every day. In my experience, undervalued businesses can be found at two ends of the spectrum. At one end of the market, it may underappreciate the sustainability of competitive advantages or also the length of the actual growth runway that the company possesses. These companies very often defy the norm of cyclicality and reversion to mean. At the other end of the spectrum, there are companies that might be experiencing challenges due to cyclical factors, changes in the environment, or their own past actions of the management. But if the core business is healthy and a path to a better future in terms of cash flows, in terms of return ratios is visible, then their depressed valuations today offer a very attractive entry point. The opportunity, if you think about it in both cases, is to buy something cheap relative to expectations. This approach resembles, in a sense, what I call a barbell approach to investing. I like to combine both approaches, both top down and bottom up. If you think about it, investing is about buying a good business at a price where it offers value and then sitting still thereafter as the business delivers. But the reality is that the market goes through waves in which sectors can experience derating and re-rating, and this provides an opportunity as a fund manager to generate alpha. An important distinction to keep in mind is that the forces of mean reversion work on sectors and sector valuations much more strongly than they do on individual companies. In other words, an individual company can experience a very differential outcome due to its competitive advantages, but for the companies of a sector in aggregate, the forces of mean reversion are rather powerful. This implies that the approach towards owning individual companies and the sector weight of the portfolio has to be different. Valuations, in my opinion, provide a prism through which one judges the attractiveness of individual sectors. My preference is to manage the portfolio with all positions carrying what we call an active positive weight. That is to say that if the fund owns a company which is in the benchmark index, the position would typically in the fund be in excess of the benchmark weight, or what we colloquially refer to as being overweight. Otherwise, the position would be zero. In other words, the strategy would either be overweight an index stock or have a zero position. It's pretty much an all or nothing approach. As for stocks that are in the fund but not in the benchmark, by definition it is an overweight position. As a result of this approach, the active risk in the strategy is quite high and the performance deviation relative to the benchmark can also be high. But if your target is to manage a strategy with a target for higher alpha, then I do believe that this is appropriate. Growth in earnings is undoubtedly the source of wealth creation over longer periods of time, but forecasting those earnings precisely is very difficult and may even be impossible. That is the message from history. It is more important to monitor how a company is managing its competitive position, its capital allocation, rather than obsessing over consensus earnings expectations and changes in those expectations. Having a positive view on earnings is different from relying on precision in earnings forecasts.
Hi, I'm Ajay Tyagi. I'm part of the equity investment team here at UTI, and I follow the growth style of investments. Today I shall take you through some of the tenets of my investment philosophy. The value of a business in its most fundamental sense can be derived by considering the value of cash flows that the business generates over its lifetime and then discounting them back to the present date. Implicit in this assumption is the concept that businesses should generate more cash than what they consume, and therefore the net cash generated, also known as the free cash flow, becomes the source of economic value and ultimately wealth creation for its shareholders. If you were to check the history of long-term wealth creators, you would realize that the common attribute that all of them held was a strong free cash flow generation. Why I emphasize more on cash flows than profits is because many companies can have strong accounting earnings, though they may be having poor cash flows. But as explained above, the real source of value creation in a business is its cash flows and not accounting earnings. Therefore, focus on cash flows builds in a margin of safety in picking winners and multibaggers. Quality signifies the ability of a business to sustain high return on capital employed, called ROCE, or return on equity, also called ROEs, over a long period of time. Truly high quality businesses are those that are able to generate high ROCs and also high ROEs even during difficult times for the industry or sector, and therefore operate above their cost of capital at all times. More often than not, a business with high ROCE or a high ROE shall be able to generate strong cash flows and therefore generate economic value as explained earlier. Growth, on the other hand, signifies long-term secular growth for businesses. I like businesses that have steady and predictable growth trajectory and where long-term drivers for such growth can be understood with higher certainty rather than having cyclical or unpredictable growth. While high-quality businesses create economic value, a high-growth business enables compounding of this economic value. It is for this reason that my favorite hunting ground for stock selection is the intersection of quality and growth. Such businesses are very rare, but my philosophy is to stay focused only on such businesses, even if it means not finding a new idea for many quarters. Bottom-up signifies focusing on the underlying economics of a business as the key stock selection framework. Under this framework, we try to focus on the fundamental attributes of the businesses like its growth prospects, industry outlook, margin profile, competitive dynamics of the industry, cash flows, ROCs, etc. For a true bottom-up focused approach, the role of macros is really very limited and in fact insignificant. Since I follow an undiluted bottom-up approach, I focus all my energies on evaluating the businesses, albeit with different prisms, to build a robust hypothesis. As a corollary, the impact of inflation, interest rates, fiscal deficit, etc. is very limited in my investment approach. I like investing into a business as if I'm a part owner of the business and hence would be holding it for a long period of time. Once your investment framework is aligned towards investing into a business rather than investing into a stock, the relevance of macros and cycles reduces considerably. As mentioned earlier, my starting point is to establish the quality attribute of a business. In other words, businesses with high return on capital employed and high cash flows are the ones which are preferred. At the same time, predictability of the business is very important in my framework, as I like to understand how the business would look like in a few years down the line. It is for this reason that businesses with poor or average ROCEs and a cyclical characteristic are the typical businesses that I like to avoid, which basically means that businesses with commodity kind of attributes like metals, oil and gas, construction, etc. are usually avoided. On the other hand, a lot of consumer-facing businesses across sectors like banking, consumer staples, pharmaceuticals and autos are the ones where majority of the fund holdings would come from.
Thank you very much for your time today, and I hope you can use the power of 3 from UTI in your investment portfolio.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.